Hello and welcome back to Moneycontrol's live stream. You're watching Closing Bell with me, Ravisha Darad. Well, if you look at the markets right now, we did see that the Nifty had reclaimed that 26,200 odd levels, but right now you can see that it is back back below that 26,200 odd levels as of now. But yes, if you look at Sensex, that is also showcasing flat but with a positive bias as of now. 30 points gain that is coming in for the Sensex as of now. But yes, if you look at the broader end of the markets, that remain quite mixed. Midcaps have been down. If you look at the Nifty midcap index, flat with a positive bias, but the small caps have found some fervor in this market. Nifty small cap index up by about 0.4%. So yes, it has extended the gains to about the fourth consecutive day. But yes, having said that, India Wix, that continues to cool off. 2% downtick that is coming in from India Wix, but it is showcasing that there is no sign of immediate panic. But apart from that, let's take a look at the sectoral front of where we stand. If you look at the Nifty Metal Index, that continues its winning streak to about the fifth consecutive day. So the likes of NMDC, SAIL, Hindustan Copper, all of these counters have been doing well. And similarly, buying traction has been seen in private bank, FMCG stocks, Nifty FMCG up by about 0.5%. So both of these counters have been doing well as of now. But yes, on the flip side, IT stocks have taken a beating. More than 0.5% decline has coming in from the Nifty IT index basket. It has snapped 4-day gains as in all. But yes, all in all, it has been a range-bound day for the markets, given it is also the weekly expiry, so no major movement which has happened today. But yes, currently, let's take a quick check of the top gainers and losers list of where we stand as of now. If you look at the gainers list, Coal India has done well. Its subsidiary, that is your Bharat Coking Coal, that plans about 1,300 crore rupees of IPO, and as a result of which the stock is up by about 3.5%. Shriram Finance also up for the fifth consecutive day on the back of Japanese bank 20% acquisition. So yes, the stock has been up by about 2%. UltraTech Cement also seeing good traction, 1% gains coming in, given that we have seen Ambuja Cement's merger with Orient and ACC. So cement stocks as a whole have been resilient. Tata Motors passenger vehicles seeing a gain of about 1%. ITC also seeing buying traction by about 1% itself. But yes, what is not doing well and what is on the top Nifty 50 losers list, that is your Bharti Airtel with about 1% cut. Infosys, Tech Mahindra, all of these tech stocks have been dominating the top Nifty 50 losers list. On the other hand, pharma stocks have been also down. Sun Pharma and Cipla showcasing a decline of about nearly 1% itself. But yes, to understand how the last minutes of the trade look like and how you should be positioned in a trade environment like this, I quickly go across to the technical expert of the show. Joining me is Osho Krishnan, Senior Analyst, Technical and Derivative Research at Angel One. Osho, good afternoon. I mean, it's a volatile trading day given it's a weekly expiry day, but no major fall on the headline index front. So can we say after all that it has been a decent day?
Very good afternoon, Ravisha. Firstly, thank you for inviting me at the show. Well, yes, no doubt today there has been a kind of a choppy and lackluster trading session consisting that it was a weekly expiry day, but overall the sentiments remain on the positive front. The broader market remains positive, bullish, and I'm expecting that in the coming period, it is highlighting that from current levels there is a strong potential to reclaim the zone of 26,325 for Nifty. So overall, the setup has been positive, and I'm expecting that this might be the initiation of the Santa rally. Although on the higher end, 26,200 remains a critical hurdle. So a closer above 26,200 will be very crucial for Nifty, because from there onwards, we can expect the momentum of higher highs forming on the daily time frame chart. So although I'm expecting that dip should be well, 26,120 to 26,100 should be providing very strong cushion to the benchmark index. While on the higher end, a conviction will come once Nifty breaches the zone of 26,200 on a decisive or sustained manner. Then from there onwards, we can expect another 150 points of rally on very immediate perspective. And even after that, we can expect 26,500 to be seen on a very short-term duration. So overall, the sentiments remain positive, and there has been thematic movers which has taken the whole focus for the day. As you mentioned, that metal space is looking very positive. So focus should be on thematic movers when the benchmark index or the key indices are witnessing a lackluster trading session.
Okay, all right. Osho, what about the India VIX? I mean, it's fallen to about 2%. It's near its all-time low levels. How are you reading into this?
See, overall, there has been no strong momentum that was being seen in the India VIX index. So overall, in the past few months, there has been no strong conviction in India VIX. And now it is at the historical lows level. So from here onwards, one can expect that market might see some kind of a strong momentum on the higher end. So that will be a positive setup. But overall, I am not convinced that the setup of India VIX will have anything to do with the market trends. Overall, I'm expecting that from here onwards, there will be positive momentum that can be seen in the coming weeks.
Okay, all right. Let's also talk about the metal stocks because you were talking about that earlier. It's done well for the fifth consecutive day. Do you think that at the current price point, investors can still mark an entry?
There should be some selective counters which are looking very positive from the metal space, like Steel Authority of India has seen a very strong momentum in the last two trading session. It is a kind of a pullback that has been seen in sale. The other counter, NMDC, have given a very strong breakout, so that should be also seen as an opportunity of momentum buying. So overall, there should be stock selection, exclusivity in the stock selection. Some of the counters are looking very positive at current levels also and can be seen for buying opportunity from short to medium term perspective. For sale, I am expecting a target of nearly 138 to 140 on a short term time frame, while 128 should be auguring well for any kind of dips in the coming future. So that should be even kept as a stop loss, and 138, 140 should be seen as the immediate target in sale.
Okay, all right. Sale as a stock we need to watch out for. But yes, let's talk about IT stocks because it snapped its 4-day gains today. Osho, how are you placed on the overall theme? Because today we have seen a bit of a profit booking on the tech names.
There has been some correction or some profit booking in the major of the IT counters, but overall the technical setup still is on a positive front, and I'm expecting that from short to medium term perspective, this is an opportunity to accumulate majority of the counters. For example, TCS being the giant of the IT counter, it has witnessed a positive divergence from the technical parameter. So that is a very positive setup on the weekly and daily time frame chart, and that should be considered to accumulation zone. Any kind of dip towards the zone of 3250 to 3220 kind of zone should be seen as a buying opportunity. Overall, I am having a bullish approach in the IT space, and for TCS on a very short term perspective, I'm expecting nearly 3900 on a medium term perspective, 3900 as the target. On a short term time frame, 3450, 3500 should be seen as an opportunity, and one should try to accumulate discount.
Okay, all right. That's the view from the IT space. But yes, let's also talk about the railway stocks because they have been auguring some momentum from the past 3 days. Osho, can we see a pickup of momentum or is this just a short-term phenomenon ahead of the budget?
Overall, I'm expecting that this is the first initial sign of trend reversal in majority of the railway counters, but that can be correlated with the pre-budget rally. So one should definitely try to gauge momentum in majority of the counters. Although on technical front, the breakout is still pending. I am expecting that in the coming future, there is strong potential of breakout in majority of the counters like Titagarh Rail System, IRCTC, RVNL. All these counters are looking very positive from short-term pullback. But a decisive breakthrough, for example, for Titagarh, a strong resistance is placed around the zone of 900. So that is a very strong resistance level. So for short-term pullback, yes, definitely it is an opportunity to accumulate the counter for a target of 900. But conviction will even increase once it breaches the zone of 900. And from there onwards, one can expect a target of nearly 1100 to 1150 from short-term perspective. So overall, I am having a bullish approach, but conviction will be increased once there will be a strong breakthrough in majority of the counters.
Okay, all right. That's the view coming in from the railway stocks. But today's focus has been on Ambuja Cements announcing merger of ACC and Orient Cement to create a consolidated single cement platform, and the proposed consolidation is expected to be completed over the next year. But yes, brokerages have said that the amalgamation can unlock value for the shareholders and improve its operating efficiency as well. Analysts have estimated proposed merger can lead to a value creation of over 12% for Ambuja Cements shareholders itself. But yes, Osho, I mean, Ambuja Cements, a percent gains for the counter, and Orient Cements has also done quite well, but ACC shares have fallen. So how do you view this sentiment and what lies next for all of these three counters?
Technically, I'm expecting that still the downtrend is still not over in these counters. There, the technical setup is still on the formation of lower lows, lower highs for majority of the counters. Firstly, for Ambuja Cement, yes, no doubt there has been a kind of a pullback that is being seen in today's session, but overall, again, the zone of 550, 560 still remains a sturdy hurdle. So a breakthrough above 560 will be awaited. If it happens, then from here onwards, there can be a further momentum play that can be seen from short-term perspective. So one should play with the pullback rally or pullback momentum, but from a structural change, I am not witnessing any kind of a structure change in majority of the cement space counter. But from short-term pullback, yes, definitely there can be some kind of traction in majority of the cement space.
Okay, some traction could be visible for the cement counters, and you can see that apart from ACC, both Ambuja Cements and Orient Cements have been doing quite well. But yes, what did not do well in this market, that was your shares of Coforge. The stock is down by about nearly 5%, given that the company announced plans to consider a fundraise proposal. Now, this is the second fundraise that the company has planned over the last 18 months. And previously, also the company had raised about 20 to 40 crore rupees via its QIP. Now, the stock has been under pressure because the market is concerned about the risk of further dilution due to the fundraise, and the company's cash guidance, cash conversion guidance has been one of the weakest among its peer groups as well. Osho, if you look at the stock, sharp decline in the counter, so can we expect further fall going ahead?
With looking at the momentum in this counter, I'm expecting that another 100 or another 70 points of correction can be seen. Near about 1700, 1680 is the next potential support levels for the counter. So one should stay sidelines from the space. Overall, there the structure remains on the positive front, but these kind of corrections should be considered healthy only from medium to long term perspective. In the short term time frame, the further correction is still pending in the counter. I'm expecting it might test the zone of 1700, which even coincides with the 200 exponential moving average, followed by 1680 kind of zone. And from there onwards, one should look for buying opportunity in the counter, because structurally, as I mentioned, that from medium term point of view, the counter is looking very positive. But from short term, yes, there is some pain that can be seen in the counter.
Okay, medium term looks positive, and 1700 is the next support zone for the Coforge. But yes, let's talk about Puravankara, because that stock has done quite well. 6% gains came in for the counter after the company has announced acquisition of a 53-acre land parcel in Bengaluru itself. And now the acquisition has been aligned with the company's strategy to expand across key markets of Bangalore itself. Osho, I mean, good breakout on the charts for this particular real estate counter, but can the rally really sustain going ahead?
Overall, there has been a strong spurt in volumes. The counter has seen a kind of 80 to 90 times of average trading volume. So that is a very positive setup for the counter. Although on technical front, it is still hovering below the 200-day exponential moving average. So conviction will come only once it breaches the zone of 270, 275 on a decisive manner. Then from there onwards, we can expect some kind of continued momentum in this counter. For now, it's better to stay sidelines and wait for a breakout in the space. If it happens, then only one should look for buying opportunity in this counter.
Okay, all right. That's the view for Puravankara. Another stock in focus which has been doing quite well, that is your Shakti Pumps. You can see the counter has gained nearly 2% after it secured an order which was worth about 350 crore rupees of from Maharashtra State Electricity Distribution Company itself, and as a result of which the stock has gained momentum, 2% gains as of now. Osho, what about, Shakti Pumps? Because the stock has been an underperformer so far this year, but today it's seeing some bit of a recovery. And over the past 1 month also, we have seen a bit of a recovery. So can we expect further rebound going ahead?
In the last 2 weeks, there has been some traction in terms of volume. So there has been a volume pickup in the counter. There has been a reversal from the oversold terrain. So I'm expecting that in the short term perspective, the base formation has been made in the counter. Although a breakout or a sustained move above 760 can provide some breather in the space, and the counter can see some kind of pullback rally in the coming future. So overall, I'm expecting that yes, no doubt the counter have seen a decent momentum in the recent 2 weeks. So 680, 685 should be seen as a very strong support levels. On the higher end, a breakthrough above 760 can give further momentum towards 860 to 870 kind of zone from short term point of view.
Okay, all right. 760 is the level that we need to watch out for this particular counter. But yes, let's move on and talk about Samvardhana Motherson, because this particular stock has been trading off the day's high after it touched about 52-week highs later in the earlier in the session. And the move has been coming after the company has announced that its subsidiary, that is your Motherson Global Investments, will be potentially acquiring 100% of the global wiring harness business of Nexon Auto Electric. Now, the brokerage's view on the deal remain quite mixed, because if you look at Nomura, they have said that the acquisition would help the company foray into the global passenger vehicle wiring harness segment. However, Kotak has shared a sell call on the counter, saying that the acquisition looks to be marginally EPS dilutive over the near term. Osho, how does the stock look like? I mean, the stock has been quite flat with a positive bias as of now, but it has seen a structural upside. So, what can we expect in the near term?
Overall, the structure is very positive in the counter. I'm expecting that further correction towards the zone of 115 to 110 can be seen as an opportunity in the space, because overall, in the current financial year, the structure is very positive. It has been in the cycle of higher highs, higher lows. So, any kind of further correction towards 115 to 110 should be augured well, and one should try to accumulate on any kind of dips in the zone, because even on the Fibonacci retracement, the counter have seen more than 61.8% of retracement from the correction that the counter have seen from September till April month. So I'm expecting that the structure is very positive. One should try to accumulate this counter on any dips towards the zone of 110.
All right, any dips towards 110 can be used as an accumulation point. All right, let's move on and talk about Granules India, how this particular stock has been doing, given that the board has already approved fundraising of about 1760 crore rupees as of now. Osho, I mean, the stock has fared well over the past 3 months. Today, the stock is showcasing a gain of about 2%. What lies next?
Overall, there has been very strong momentum in the last 2 weeks. The counter have seen a breakout above the zone of 575, and from there onwards, it has been into a very strong and vertical rally. Overall, I'm expecting 620 to be seen as a very sturdy hurdle. So at present, it will be advisable to trail profits at higher level. 600 will be the stop loss that will be advised for the counter, because 620 historically have have witnessed a rejection from the higher end. So 620 is a very crucial hurdle. A breakout above 620 can again provide some momentum in the space. So therefore, one should try to either accumulate positions on any kind of dip towards the zone of 580 or above the zone of 620 or 625. At present, it will be advisable to trail profit. 600 will be the advisable stop loss.
Okay, all right. That's the view for Granules India. Let's move on and talk about Antony Waste. The company has been doing, given that the company arm has bagged about 330 crore rupees order from Thane Municipal Corporation for a 10-year period, and this marks its second order win over the last 1 week itself. Osho, what's your take on the stock, and what target levels can we watch out next? Because today the stock has seen good volumes.
Yes, in the last four trading sessions, the counter have gained very strong volume. So I'm expecting that this might be an early signal for reversal, because on the higher end, the 200 exponential moving average is placed around the zone of 545. So that will be a crucial juncture to watch out for. If it breaches the zone of 545 on a decisive manner, then it might witness another strong rally in the coming future. Or if any kind of correction or any kind of profit booking from current levels towards 500, that should be also seen as healthy correction and should be seen as an opportunity to accumulate the position. So 500 will be the advisable zone to accumulate the counter. On the higher end, 545 is the first target. A breakout above 545 can provide further room for the counter in the coming future.
Okay, all right. That's the view for Antony Waste that is coming in. The stock has been trading well today. But yes, let's move on and talk about GPT Infra Projects, because that stock has been also exhibiting gains of about 2%. And the company has emerged as the lowest bidder for 670 crore rupees worth of project. And this is the fifth order win for the company that it has announced in the last 2 weeks. So yes, back-to-back good order wins that is coming in for the companies. Osho, today the stock has done well, but it has been quite sideways. Can we expect gains to sustain from today?
Overall, I'm not witnessing a kind of a reversal in the counter, but definitely there has been increase in the trading volumes. So one should wait for a decisive breakthrough above the zone of 117. If it closes above the zone of 117, then from there onwards there can be a sloping trend line breakout, conviction will be higher once there will be a sloping trend line breakout in the space. So overall, one should wait for a breakthrough, and from there onwards, one can look for buying opportunity. The next potential hurdle is around the zone of 132 to 135. So that should be the first target from short-term point of view.
All right, that's the view from GPT Infra Projects. Let's talk about RITES as well, because that stock has also risen in trade today after it received a letter of award which was worth about $35 million from Nadlama Capital for the supply and commissioning of diesel electric locomotives. Right now, the stock has been gaining by about 4% and it has seen some good volumes, but it has been oscillating between 200 to 250 odd levels for some time now. Osho, what's your next target and what's your take on the counter?
Firstly, the counter is into a kind of a sloping channel trend, so I will be awaiting for a breakout in the space. The overall resistance is placed around the zone of 250, so that will be a crucial hurdle. If a breakout happens above 250, then it will be a buying opportunity in the space. On the higher end, 285 to 290 will be the next potential target, while on the lower end, 230 to 35 is a support zone. So buy above 250 with a stop loss of 235, and potential target is nearly 285 from short-term point of view.
All right, 250 as a resistance and 235 as a stop loss for RITES as of now. All right, let's move on and talk about HFCL, because this stock has also been doing well. 3.5% gains that is coming in for the counter after the company launched its QIP yesterday at a floor price of about 65 rupees per share. Osho, what's your view on HFCL? Today the stock has been seeing good gains, but it started the year with about 110 rupees and right now it's trading sub 70. What can investors expect in the near term?
Technically, the counter is at very strong support levels because historically the zone of nearly 60, 55 has provided very strong cushion to the counter. So at present, it won't be advisable to exit from the invested position in this counter. But my conviction will increase if it breaches the zone of 72 to 74 on the higher end. Then there might be a strong momentum that can be seen in the counter. At present, it is at oversold terrain, so that will be early to say or predict that from here onwards there can be a pullback or not. But a breakthrough above 74 can be seen as buying opportunity, and from there onwards, another 86 to 88 will be the next potential target that one can expect in this counter.
All right, 74 is the next target that we need to watch out for this particular counter. But yes, just last 4 seconds to 4 to 3 seconds left before we hit the closing. Let's take a quick check of how the closing rates look like for the markets, because so far it has been a range-bound day on the back of the expiry-related jitters as well. But yes, Nifty has closed below that 26,200 levels. It has snapped its 2-day gaining streak and it has closed with about 6 points downtick. And if you look at Sensex also, that is also closed with about 65 points downtick for the Sensex benchmark as well. Let's take a quick check of the broader end of the markets, how they have been faring today. If you look at the Nifty midcap index, that has closed flat with a positive bias. It's extended the day gains to about the 4th consecutive day. And even for the case of small caps, they have shown a little bit of a participation, 0.3% gain coming in for the small cap index as well. But yes, what did not do well in this market were the IT stocks, 0.8% decline that came in from the technology pack, and as a result of which we can see that the large cap IT names have taken a hit. If you look at TCS, that has showcased a decline of about 0.4%. Infosys, Wipro, Tech Mahindra, all of these names have been one of the top laggards as well. On the other hand, if you look at the Nifty FMCG index, Nifty metal index, all of these counters have fared well in today's trading session. But yes, overall, the market setup has been quite range bound, given that we started with strong global cues, but no support that came in from that, because it was the expiry day, so some volatile swings also crept in the markets. But yes, apart from that, we can see auto index has also cooled off today, nearly flat with a negative bias, so to say. And if you look at the other index, that is your Nifty Realty as well, that is also showcased, and settled with about flat with a negative bias. But let's take a quick check of how the top gainers and losers look like on the charts as of now. Coal India soaring in the trade, 4% gains. Shriram Finance, ITC, UltraTech Cement, Tata Steel, all of them are the top Nifty gainers as of now. The top Nifty losers include the likes of Infosys, Bharti, Airtel, Adani Ports, Sun Pharma, Tech Mahindra. So yes, IT stocks definitely one of the top dominating list as of now. But yes, let's talk about Coal India because the stock has done quite well. 4% gains came in for the counter after its subsidiary is planning an IPO as well. Osho, what's your view for Coal India? Because the stock has done quite well, one of the top Nifty gainers. What can we expect next?
Overall, technically, the counter has been into a very strong consolidation zone. In the current financial year, the counter has been hovering in a very tight range of 375 to 400 kind of odd levels. But on weekly time frame chart, after the recent consolidation, this today's trading session has contributed towards a breakout. So I'm expecting that if there will be a follow-up buying, any breakthrough or any follow-up buying towards 405 can provide very strong momentum in the coming period, and I'm expecting that 435 to 440 can be seen as the immediate target in Coal India. So at current levels, I'm having it in my watch list. If there will be a follow-up buying, then one should definitely try to gauge momentum and could accumulate positions in Coal India for 435 to 40 as a target.
Okay, all right. Let's talk about Cipla as well because the stock did see a little bit of flat to a range-bound movement, nearly a percent decline that came in for the counter, given that the company announced the launch of Afrezza insulin inhalation powder in India itself, and this product marks the company's entry into a needle-free insulin delivery option for diabetes patients in the country itself. But yes, Osho, what's your take on the stock? Because the stock has fairly been a no-mover this year.
See, overall, I'm expecting that, as you mentioned, the counter is into a strong consolidation. There has been no technical trend formation in the space. So I expect that any breakdown below the zone of 1470 can aggravate the sell-off in the space, or any breakout above 1550 can again pave out a fresh bullish rally in the space. So I will be waiting for a consolidation breakout in Cipla. If it happens, then according to the trend, there will be a trade setup that can be suggested in Cipla.
Okay, all right. That's the view for Cipla as of now. But yes, let's talk about one of the other Nifty gainers today. That's your Shriram Finance, showcasing a gain of about 2.5% itself. Osho, what's your view? I mean, yesterday we did see a Japanese bank's acquisition news. That is what kept the NBFC giant going ahead, and now it's extended the gains to about the fifth consecutive day. What would your advice be to the investors to approach Shriram Finance at this point of time?
Technically, this counter is into very strong overbought terrain. So there has been highly overheated parameters or developments that are being seen on daily or weekly time frame chart. But looking at the momentum and volume setup in the last three trading session, it will be advised to stay with the momentum until there is some kind of profit booking is being seen in the space. Trail the profits on the higher end because 925 will be the immediate support levels for the counter. So trail stop losses towards 925 and try to ride the momentum for the timing, because technically it has now been on the very higher end. So at present, it is not favorable from a risk reward point of view. But as the momentum persists, one should stay invested. Or in future, if there will be any kind of profit booking, then a zone of 900 and 880 will be a decent levels to accumulate this counter. On the higher end, next potential target is 980 followed by 1000.
All right, that's the view for Shriram Finance, up for the fifth consecutive session itself. But yes, so just one last question before we let you go, Osho. What are your top picks? I know we discussed a range of stocks, but what are you finding interesting right now?
There are two counters which are looking very positive. First one is GMR Airport. GMR Airport has seen a very strong pullback from the 100 odd levels, and from there onwards, today the counter has nearly gained 2.6% on the higher end. So I'm expecting that the momentum can be seen in the counter in the coming day also. So 110 is the target, and 101 should be the advisable stop loss from short-term point of view. The other counter where I'm witnessing a kind of a consolidation breakout is Asian Paint. So one should look for buying opportunity in Asian Paint around the zone of 2800, keeping a stop loss of 2770, and on the higher end 2860 will be the next potential target that one can expect in the short term perspective for Asian Paint.
Okay, all right. Those are the two counters we need to watch out for. But with that, we have to let you go, Osho. Thank you so much for your time and joining us.
Thank you so much.
All right, it's been a fairly range-bound day for the markets, and if you see at Nifty, that has snapped its two-day gaining streak itself. No major news or fresh catalysts were available today, which is why we have seen the markets remaining quite directionless as well. And of course, it has been on the back of the weekly expiry as well. So as a result of which, it's an year-end traders have been squaring off their positions because it's nearly the year-end as well. But it's an important data point that came in where reports have indicated that foreign institutional investors have increased their holdings on Indian stocks by the most in 2 months last week as the rupee rebounded from a record low. If you look at overseas investors, they have bought about $644 million worth of local shares, and this has been the highest since mid-October according to the Bloomberg data. Now, the inflows have been coincided with the rupee posting its biggest weekly gain in nearly 6 months, following nearly $1.8 billion of equity outflows over the prior 3 weeks when the currency had slid more than 1% itself. Now, whether this is a meaningful reversal in terms of flows or not is something that we will be watching out for. But yes, if you look at yesterday's flows, the FIIs had turned net sellers after 3 days of consecutive buying in the Indian markets. We'll watch out how the numbers pan out today, given that it has been one of the expiry days, and like I was mentioning, that traders would be squaring off their positions as the markets have been nearing a near end or to the year itself. But yes, for now, today the markets have been fairly quiet. Whether or not the mood revives tomorrow is something that we'll be watching out for as well. But yes, from a sectoral front, we did see that the metal stocks have continued to shine for the 5th consecutive day. However, IT stocks saw a bit of a profit booking, snapping its 4-day gains as of now. But yes, to understand how the markets look like from the long-term point of view, we'll understand from our next guest of the show. Joining me, a special market voice, that is market expert Sunil Subramaniam. Sunil sir, good afternoon. I mean, this year has largely been a phase of consolidation for the markets. So as we look ahead to the next year, what factors do you think would work in favor for equities, and what risks should one be mindful of?
So I think what would work in favor for equities would be, I would say, is that it's a very reasonable expectation that in the space for a whole year, the trade deal should get signed in some form. So I think that to expect that another 365 days will go through with no progress on the trade deal is an extremely pessimistic view. So the realistic view is sometime during the course of the year, the trade deal in some form, at least an interim deal, will get signed. So I think that's the first, I'd say, realistic approach one should take. So based on that, I would say that you should also expect that the return of the FII, which will take place in probably 3 stages. First is a reduction in the selling pressure. The second is, of course, them reassessing the valuation part. And the third is based on how the growth of the Indian economy and the stock market CPS growth look, they would come in either full force or in half force or this. So I think the return of the FII, but in what form and how is the second thing I think we should reasonably place our optimism around equities for the next year. Now, what are the risks? Risks are two-wayfold. That is the extreme risk of the year passing by without a trade deal, which is an extreme tail end risk, but it's there. Second aspect is that, yes, the trade deal does get signed and FIF selling debts gets stopped or reduced and all that. But if the Indian growth story, you see that one of the things with the Indian growth story of 2025 was that while the GDP growth sustained in the face of tariff pressure and everything because of the steps, fiscal as well as monetary policy steps taken, the fact is that nominal GDP has been on a slightly declining trend, which is not good news from a corporate EPS perspective. So the biggest risk for the market is that inflation doesn't go back up from these 2% levels or WPI negative, and that if the nominal GDP continues to stay around the 8.5% level, that doesn't augur well for the EPS growth. So to that extent, our valuations as a country for an FII will still seem too expensive, because only growth can justify those valuations. So I would say that the factor that the risk is that those earnings get delayed in terms of revival, that RBI's actions of rate cut and liquidity do not succeed in boosting the demand and to boost inflation slightly. RBI's own policy said that it should be around 4.1% for the first quarter of the next fiscal year. So if that comes through, I think that's good, because then you will see double-digit nominal GDP growth, which would augur well for a stronger double-digit stock market EPS growth. So I think the risk is the delay in the EPS growth coming back from the levels that it saw last year.
Okay. Sunil sir, you also mentioned that there is a delay in the India-US trade deal, which is also, playing out in the minds of investors. What does it mean for rupee then? Because we have global brokerages who are forecasting that rupee could fall further to about 92 per dollar. What's your assessment? Because so far it's been recorded as one of the, worst performing Asian currency.
So I think that one worst performing year definitely means that the next year will not be the worst performing currency because a lot of the future has been discounted. Second is almost $20 billion of FII outflow contributed to this decline. So not just the trade deal hangover, but the FII outflow. So like I said, I do expect reasonably that FII outflows next year would not be the same. Even if there were net outflows, it would be far less. And I would expect that reasonably a positive or FI outflow can be expected. So pressure on the rupee in the near term from a 1 year perspective, I would say will be less. But bear in mind that the RBI, who's entered into a 3-year swap deal, inherent in that pricing is showing that 3 years later the rupee could be at around 97 levels. So clearly a 2.5% per year depreciation is what the RBI has factored in terms of that rupee dollar, that swap that they did. So from that point of view, you should say that it's not that the rupee cannot weaken. Rupee will weaken, but it would be more in tune with the difference in the interest rates between US and India, which is around 2.5%, right? R is about 6.5, 6.6. Theirs is sub 4. So around that kind of a depreciation is a normal fundamental depreciation one should factor in. If FI flows come back strongly, you could see a much lesser depreciation. So that's a factor which we need to keep in mind. So I would say that the weakening of the rupee is not something that's going to deter the FIIs for the simple reason that it's already gone way above what a normal depreciation should be. And if you look at the rupee from a RER, weighted average perspective, right, in September last year, 2024, it was at around 106, 107. That is, it was overvalued. But now, if you see the RER levels reported, I've read about 95, 96 levels. So clearly the rupee is not overvalued. So there is no fundamental pressure on the rupee to weaken, but a gentle depreciation is something that you should factor into account, which I would not say will be worrisome for the FIS, because when they look at investing from a dollar currency into an emerging market, they'll always take some level of depreciation into their calculations. And as long as it's 2 to 3%, it's fine.
Okay, all right. 2 to 3% could be fine. All right, Sunil sir, what about, from the earnings front? Because small caps have seen significant pressure this year, yet we have seen that the AMFI data has shown steady inflows into the small cap funds. So how are you interpreting this divergence, and what continues to drive the investor confidence in this segment?
So I think the first, let me address the last question first. So the investor confidence is driven by the fact that, leave alone a bad 1 year, the 3-year returns, even in small cap funds, are still quite healthy. So I don't think investors are going about changing their asset allocation pattern because of one bad year, because I would credit the mutual fund distribution ecosystem, which has done a very good job in explaining to people about the volatility of the small cap and keeping going. Second aspect, there is a significant proportion of the small cap fund flows are through SIPs. Now, people don't just go and stop an SIP or change it into a large cap SIP because you've seen 1 year of underperformance. The tolerance levels of investors and stroke distributors for an SIP, because an SIP is very ethos, is that the correction, that last 1 year's correction in the small cap index has given them more units of the small cap fund. So, which means that when ultimately the recovery happens, these would be the most profitable investments they have made in terms of those installments. So, I think that's the second lesson in terms of rupee cost averaging, which has come to help people to be calm and continue sticking to their long-term goals and asset allocation. The third aspect here is that small cap earnings were also good. Yes, they were not as good as the valuations was expecting, but the earnings have been growing. So it's not that it's not been growing. What has more caused the correction in the small cap is not so much the disappointment in the earnings. There was disappointment, no doubt, but it's the action of the domestic fund managers who have chosen to buy the large caps sold by the FIIs and the larger mid caps sold by the FIIs because of the fact that there is safety in those numbers, right? And as and when they see in the future that a small cap stocks start doing better than expected, they can sell these large caps because the transaction cost of liquidating a large cap, buying and liquidating, is very less because there's large amount of free float, right? So then they can divert the money. So absent and the fact that FIs were selling the larger stocks in the country meant that their valuations were getting more reasonable. So domestic fund managers, especially in flexi cap funds and large and mid cap, where they have the flexibility to choose, they have been allocated. Even small cap funds, up to 35% they can put in either mid or large caps. So I think fund managers have been erring, not erring, I would say, have been choosing the safer side of quality known big companies to park their money, because FIs were selling, prices were not going way out of control, and keeping it there. Now I believe that as soon as the earnings season shows that the GST impact and all the impact are going to come to a good earnings season for the small cap, I would say that from a perspective of the current year, 2026, the looking year we're looking forward to, I would say that fund managers will start now diverting a little more money into the small caps to good quality stocks, but based on the earnings season as it progresses, to see which sectors are getting the benefit fully of the incentives that the government has provided through GST cuts and whatever. So from that point of view, I would say that this year could be the return of the small caps, because it's the fund managers' investment decisions in choosing large caps preferentially over small caps which has led partly to the correction, and that will reset itself. And one more factor which would contribute to that, Lavisha, is the fact that when FIs come back, they will tend to buy these large caps. And so when those prices rise, you will find that the fund managers will be happy to sell them at a profit. Having bought them last year when they were correcting, I would be happy to sell them the profit to them and take that money and then divert it into mid and small caps. So return of the FII could very contrarian kind of thought process lead to a rally in the smaller and the mid caps because of the DII's action in parting with their large caps to the FIIs and then turning that money into the mid cap and small cap, where the growth visibility is clear based on the earnings season as it progresses through the year.
Okay. That's quite interesting, Sunil sir. But, from a valuation point of view, everyone was talking about how stretched the valuations are in the small cap space. But anything that you're finding interesting from a sectoral perspective, particularly from the small cap segment?
No, I would still point to the fact that industrials, because the capex cycle from private sector has not been fully discounted. That's one. Realty is the second, where there's a lot of correction happened over the last year, and IT, because even in IT, overall the IT has underperformed the Nifty and the broader market, but I would say it's still that those are the places where the hurt has been more. If you look at and some FMCG, but there's not many FMCGs in small cap segment, so it doesn't affect it there that much. So I would say these are the segments where the DIs have chosen not to buy, if I may pick my words correctly, right? And these are the spaces where hence there will be some degree of valuation comfort in the year coming forward.
Okay, got it. All right. Industrial stocks we need to watch out ahead. But yes, Sunil sir, what about the railway stocks? Because from the past 3 days, we have seen a pickup in the momentum after this year has largely been a year of underperformance for majority of the railway counters. Do you think that this is just a largely budget-related optimism, or is there any more durable structural story emerging here?
I think it's a budget-related optimism. So I personally would wait for the budget to actually throw clarity around the future for the railways in terms of how much money they incur for railways capex, new lines, new wagons, new all of that, and then take a call. Right now, I this sees as a pre-budget kind of a momentum building, saying government will do something for the railways companies. I think that's my view on this.
Okay, got it. What about, the cement space? Because today we did see Ambuja Cements approving the merger of ACC and Orient Cement. How do you see this consolidation shaping up the cement industry, and how would you suggest investors to approach the sector from here on?
Cement was one of the best performing in terms of EPS growth. I think they have really benefited from the government capex and all the cement and demand that's come through. And consolidation in that industry is good from a cement industry perspective. It's not good from a consumer perspective, because it means that pricing control will be there to a greater degree. Already the industry is significantly an oligopolic industry, and that a few large players do control it, though there are regional disparities in price. As you're aware, cement can't be transported more than 250 to 300 kilometers. So because of there are regional disparities, but this kind of a merger means that these companies tend to get a nationwide presence, and then they can actually, I would say, choose my words, clearly here, saying that they can manage the pricing in such a way that their costs. They are highly operating leveraged industry, as you know. So I think that will work very well. In the sense, I would say that even a 1 rupee or a 1% increase in the cement price would lead to a 4 to 5% increase in their EPS because of the high fixed costs and high operating costs that the cement sector carries. So I would say that consolidation and whatever happens is favorable for the cement, and I would recommend that, given that I expect both government capex and private capex to pick up this year. From that point of view, cement will continue to be in demand. So I would say that those who already hold these, hold on to your exposure. But the prices have risen because the earnings season has been very, very good for the cement sector.
Okay, all right. Just one last question before we will let you go, Sunil sir. I mean, looking ahead into the next year, if you had to choose between ETFs, mutual funds, and direct equities, where would you place your bets and buy?
So I would place my funds in mutual funds for the simple reason that, as I said before, I expect this year to be the year of mid and small caps. And if it's a year of large caps, then it's better played well through ETFs, because most of the ETFs are largely on the large caps. There are some coming in the broader market, but most of them are there. So going to direct stocks is very hazardous because, out of the Nifty 500 stocks, 370 stocks are nowhere near their lifetime highs. Only 130 stocks have come somewhere near. But the Nifty hit its lifetime high. We only had 130 odd stocks touch that. So 370 stocks are way below their lifetime high. So clearly it's the stock pickers market, but the stock picker also has to wait for the earnings season. So you can't buy before the news here. So to that extent, I would say diversifying through a mutual fund is a better bet than going and directly buying stocks at this point. So my clear favor then is for mutual funds as the best vehicle, because you also have the options like a multi-cap fund, which has equally divided its portfolio among large, mid, and small to really diversify across the broader market. So I would still say mutual funds are a better bet from an investor's perspective.
Okay, all right. With that, we have to let you go, Sunil sir. But thank you so much for your time and joining us.
Thank you.
All right, that's all we have for this edition of Closing Bell. We have seen that the Nifty has broken its two-day winning streak, and whether or not if there is a revival tomorrow is something that we will be watching out for. Tonight, we'll be also having US Q3 GDP data, which will be coming in, and of course, the PCE data, which is crucial for the interest rate decision path from the US Federal Reserve's point of view, is something that we'll be watching out tomorrow as well. But for now, it's a wrap from me. Thank you for watching, and we'll catch you tomorrow.